Is Fortinet a buy or a sell? Let's get started with the model. This is a large cap company, 74 billion market cap. They're trading at $97 a share, and they have 767 million shares outstanding. Fortinet is a cybersecurity company incorporated in 2000, headquartered in Sunnyvale, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. Really consistent free cash flow from 1.2 billion up to 1.7 billion. Great margins, they convert 29% up to 36% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's grown a lot from 600 million to 1.5 billion. Margins up to 27%. Revenue is the sales for the company, and that grows each year from 3.3 billion to 5.7 billion. Financials look really good. We estimated 4 years of future free cash flows. We also estimated a terminal value. It's all cash flows. Past year 4, that's 57 billion. We discounted those numbers back to today using a weighted average cost of capital. We got a value of the company of $50 billion. We divide that by 767 million shares. And we get a calculated stock price of $65. They're trading at $97, so they're trading at a 49% premium. It's a sell according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 105 companies in the same industry as Fortinet, and if they have a number in red, they're worse than median. If they have a number in blue, they're better. They spend $308 million in CapEx, which is higher than the median, lower than the average. Debt to equity ratio 1.1, a little better than the average. They don't pay a dividend. They generate 1.7 billion of free cash flow, almost equal to the average. They rank 6th in market cap, pretty close to CrowdStrike. Really inflated price multiples, trading at 48 times earnings, 45 times free cash flow. They generate a lot of revenue, 5.7 billion, more than CrowdStrike. And their 5-year annual revenue growth rate is 23%, so they're growing a lot. They're trading pretty close to their 52-week high, only 4% below it, 85% above the 52-week low. Their 50-day moving average is 84, a lot higher than the 200-day moving average. If you put $10,000 into this company 10 years ago, you'd be really happy at $171,000 today, a 33% annual return. To summarize, I have them trading at a 49% premium, ranking 5 out of 10. Would I buy it? Seems a little overvalued, so short term 3 out of 10. Long term, I probably would buy 6 out of 10. Pretty weak ratios, and financials look a little better than the average, so 6 out of 10. Let's take a look at their 10Q. Here's their income statement, third quarter 24, third quarter 23. Revenue is up from 1.3 billion to 1.5 billion. Product revenue up a little bit, 466 million to 473 million. Service revenue up a lot more, 870 million to over 1 billion. Let's see if they give a different breakdown of the revenue. Of the 1.5 billion of revenue, 450 million in US, 169 million in South America. EMEA is 600 million, APAC 284 million, and it's up in every single region. Let's go back to the income statement. Below revenue is cost of revenue. The expenses for product and service are very close, but their service revenue is more than double, which means their margin and service are much higher than product. Their total cost of revenue, 260 million, which is lower than last year, and they have higher revenue, which means their gross profit improved dramatically from 1 billion to 1.2 billion. Below that are their expenses, R&D 180 million, marketing 515 million. Total operating expenses 770 million, operating income 470 million, last year 300 million. And their net income is 540 million, 200 million more than last year. And they have less shares than last year. Last year 780 million, now 765 million. So they've improved on many different levels. Let's look at a balance sheet. Current assets 5.2 billion, current liabilities 3.9 billion. So current ratio well above 1. Lots of cash and short-term investments, 3.6 billion. Their total assets 9 billion, 1.3 billion of PP&E. Here's a breakdown of the PP&E. 460 million of land, 740 million of buildings and improvements. Computer equipment and software 280 million. So the gross value is $1.7 billion. They depreciated $413 million. So the net value is $1.27 billion. That's what you see on the income statement, the net value. $900 million of their PP&E is in US, $200 million in Canada. Their deferred tax assets are $1.3 billion. A deferred tax asset will help the company pay lower taxes in the future. Because a deferred tax asset will reduce your net income, the lower your profit, the less taxes you pay. The opposite of deferred tax liability will increase your taxes. They don't have a deferred tax liability on their balance sheet. At least they don't show one right here. Sometimes it's part of other liabilities. So total liability, $7.9 billion. Their biggest is deferred revenue. This is when they receive advance payment for a product or service before it's delivered. And another $3 billion of deferred revenue. This deferred revenue will be booked within 12 months. This deferred revenue will be booked beyond 12 months. And they have a little under $1 billion of debt. Assets minus liabilities equals equity, $900 million of equity. They raised $1.6 billion from selling the business. They lost $640 million from running the business. Let's look at a statement of cash flows. The first section is operating cash flow, and the way you calculate operating cash flow, you start with your net income, $1.2 billion. Then you add or subtract the non-cash items on the income statement. You also adjust for changes in working capital. So even though they reported a $1.2 billion accounting profit, they actually generated $1.8 billion of cash flow, similar to last year. In their investing section, they spent $280 million of PP&E. They spent $247 million of cash from acquisitions. They talk about it right here, a cash outflow of $247 million from the acquisition of Lacework and Next DLP. Lacework, it sounds like a porno site. And the last section is their financing cash flow. They received $40 million from issuing common stock, and they had a cash outflow of $80 million from the taxes on the equity awards they provided their employees. Let's look at a stock on Simply Wall Street. Its last price, $97.74 billion market cap, up 2% in the past week, up 76% in the past year. Look how much the stock has gone up since 2009. It was under $2. And it grew 50x to close to $100 currently. It's trading at its all-time high. It did break through 70 at the end of 2021, then came down, back up, then down, then up, then down. But ever since mid-2024, the stock has gone parabolic, from 57 to almost 100. Simply Wall Street's valuation is 134. They say the stock is 28% undervalued. 36 analysts priced this stock at 95. They say it's overvalued. Their revenue back in 2013 was $615 million. 3 years later, it doubled to $1.2 billion. That's in 2016. 4 years after that, it doubled again to $2.5 billion. That's in 2020. 3 years after that, it doubled again to $5.3 billion. That's their revenue for all of 2023. Now their trailing 12-month revenue is $5.7 billion. So really nice, steady growth. They were debt-free all the way through 2020. Then they added $1 billion of debt, probably for an acquisition, and it's been that level since. Their equity was higher than their debt for a number of years. Then they had negative equity, but it's positive again. Now their equity is a little lower than their debt. But they have more cash than debt. Cash of $3.7 billion, debt of under $1 billion. So they could pay off all their debt if they wanted to. They probably don't want to because they're paying a low interest rate and they could use the cash to grow the business. The CEO's salary was $450,000 in 2017. It got up to $800,000. Now it's $622,000. $16 million of total compensation, 24 years as CEO. 69% of the company is owned by institutions, 16% by insiders, and 16% by the general public. Their biggest shareholder is Vanguard at 9%. The founder at 8%, State Street, Fundsmith, that's an investment firm in Britain, BNY, Northern Trust, Invesco, Amundi, the French asset manager. Their employee count went from 2,300 in 2013 up to 14,000 currently. And the ticker trades on the Nasdaq, Deutsche Börse, London Stock Exchange, Mexican Bolsa, Kazakhstan, and Sao Paulo Bolsa. So if you want to learn how to value a company, watch the video in the top right corner. Thanks for watching.